inflation is inflating our dreams away. It hit the stock market last week with some of the ISM data, which showed prices that were being paid were much higher, surprisingly higher. And now we have a CPI coming up on Tuesday, and that looks to be higher according to the Federal Reserve. That nice car we wanted, the nice house, and the retirement savings are inflating into the air, and the stock market does not like it. And while inflation is eating the value of your dollar, your stocks are also going down if you invest in technology. I've gotten stopped out, so I've protected myself by having a trailing stop loss of 4%. But Monday, it was a tech stock washout. Palantir, NVIDIA, Rigetti, all the quantum computing stocks washed out. And Zuckerberg put another nail in the coffin of quantum computing by agreeing with Jensen Huang of NVIDIA that the quantum stocks were years off in the future as far as being practical and usable. We were down to hoping we would get at least one rate cut this year, but it looks like we're going to get no rate cuts, according to Bank of America. But the banks aren't hurting. They actually like it when the rates are cut because they pay out less interest on CDs and so forth. But the bond market has control of the long-term rates, the 10-year rates, which mortgages are based on. So when they cut the short-term interest rates, banks are paying out 4.5% on a CD, let's say. But they're getting a 7% mortgage on their 30-year mortgages, and so they make more money. So you're not hearing about banks failing anymore because they're starting to rake it in. And banks like JP Morgan have been raking it in big time. And I want you to watch this video about how this banker who he's recommending Citigroup, which I'm not particularly fond of, but he's generally high on the whole sector simply because they're going to ease regulations with Trump coming in, which usually has a short-term boom effect on banks. So everything is starting to go right for the banks. They're paying out less, they're taking in more, and they're not going to be regulated so they can do what they want and take unnecessary risks that they'll make money in the short term. They might go broke a couple years from now when things hit the fan, but they are concerned about the here and now.
Bank earnings begin later this week with many stocks in that space coming off a very strong year. The question now, can they keep that momentum going as interest rates rise? Let's ask Mike Mayo. He is Wells Fargo Securities head of large cap bank research. Welcome back. Happy New Year. It's good to see you. You say that the curtain is rising on a, quote, new era for U.S. banks. In what sense?
Welcome to the new era for U.S. banks. We're talking about more free markets, more revenues, more intermediation, more letting banks be banks. The shackles are being taken off, so less regulatory complexity, less focus on just expenses, less marginalization of banks. Do you know, Scott, that loan growth for the last couple of years has been about the worst in the last century? Loan growth on an inflation-adjusted basis has been negative the last couple of years, and a lot of this risk-taking has been done by outside the banking industry. Banks are going to be moving more front and center and letting them act the way they're supposed to.
Okay, so you're obviously talking about deregulation and expectations of that, along with animal spirits and sort of everything else that's being figured is going to happen.
Well, I want to change the word deregulation to re-regulation. But we're not talking about going back before the days of before the global financial crisis, where it was the Wild West and you had ridiculous leverage. And I went on your show back after all the catastrophes that happened. We're just talking about not sacrificing one iota of safety and soundness, but having said that, rid as much red tape as humanly possible. And if you reduce the complexity, you have more predictability about when banks want to price their goods. The hurdle rate can be lower. They can do more business. So the banks, yes, they'll benefit, but so will the clients. And frankly, the regulators could save a lot of money.
You don't think that there's a prospect of banks attempting to make riskier loans if, as you say, the shackles are being taken off, as they watch the shadow banking community make loans and get returns like they would love to have but can't make because of the current environment?
For the 4 years before the global financial crisis, bank loans grew, not quite double nominal GDP. For the last 4 years, bank loans have only grown 3/4 the pace of nominal GDP. So when I worked at the Fed starting back in the late 80s, the adage was, if it grows like a weed, maybe it's a weed. The weeds are not growing in the banking industry. The banking industry has been de-risked for the last 15 years. And by the way, if you don't believe me, believe the $7 trillion investment-grade bond market that says large bank bonds are about the same risk as regular corporates, whereas the stock market, you're giving a 40% discount. To me, that says opportunity.
Okay. Are they going to return more capital to shareholders more freely?
I think the way to frame this is that banks will have more freedom to allocate the capital the way they seem most effective. So that means, yes, probably more.
You know what I'm talking about? Dividends, buybacks, and a lot of the things that they haven't been able to do because they really weren't allowed to do it.
Yeah, more dividends, more buybacks, but also more capacity to make loans that they otherwise might not have made. If you know what banks don't know their cost of goods sold until after the Fed stress test. That's not the way to run a business. Like if you ran a restaurant, you wouldn't know what to charge for your steak. So it's the same concept here at banks. If they know their cost of capital, and by the way, if the cost of delivering that product can be reduced, then the hurdle rate lowers and they can make more loans and they can be more intermediaries, the way banking is intended to be done, as opposed to being marginalized as much as I've ever seen in my 40 years.
What about higher rates? You would, on the surface, think that they're good for lending, at least to some degree, but maybe it's counterintuitive and they're not as good.
Look, I think the biggest risk to my bull thesis on banks, and I am bullish on banks. I'm a buyer of the sector. This is the best.
You're always a buyer of the sector.
No, I'm not. I was 17 years negative from 99 to 2016. I was negative.
On the whole sector?
On the whole sector. Go back. I was on your show, during the global financial crisis. Anyway, and people called me Perma Bear. Okay, so I'm not, but right now my level of bullishness is up. And I'd say, look, you have inflection. By the way, I'm talking about a multi-year investment thesis for banks that you haven't seen for 2 decades. At the same time, you're likely to see inflection short-term in revenues, operating leverage, earnings, and you have this regulatory change taking place.
All right. I look at the performance of a lot of these stocks, as I said in the intro, that are already coming off great years. So how much of what you've just talked about has already been anticipated and is reflected in the share prices of the JP Morgans and the Goldman Sachses, which have had tremendous runs?
My top 3 recommendations, it's definitely not reflected, and that would be Citigroup, Citigroup, and Citigroup. Citigroup is by far, JP Morgan was my top pick a couple years ago, and then I shifted JP Morgan. I think the earnings will be good, by the way, this coming Wednesday, JP Morgan. But Citigroup, I think the stock can double in the next 3 years. I say it's a new era for the banking industry. It's also a new era for Citigroup.
Because of what Jane Fraser has done to try and remake the bank.
And she has remade,
so to speak.
The curtain's just rising on Citigroup's changes. There's a disconnect between the changes Citi has made and the financial benefits they're likely to see. They're going from 50 years of this global matrix management structure, ridiculous, to 5 lines of business: payments, banking, markets, consumer, and wealth. And that's only been in place for 3 quarters now, not even a whole year. There's a CEO in charge of each one of those lines of business. There's transparency, there's a profit and loss statement, there's returns, and there's targets. And it's exactly what Procter & Gamble did and led them to become the best performing stock in the consumer staple space. So in a way, Citigroup is the Procter & Gamble of the banking industry, and that's per our analyst at my firm, Chris Carey.
What about capital markets benefits for the players that would obviously stand to make the most money within that new universe, if you want to put it that way?
Well, look, 2 words. Game on. It's game on for capital markets,
But it's not game on for everybody equally.
No, definitely not. And you see some of these capital market stocks, and they've run up, and it's a fair question. How much is priced in? But I think an inexpensive way to play capital markets would be, once again, through Citigroup. They're a top 5 global capital markets players, so you don't have to go for the ones that have already taken off. Citigroup stock,
Citigroup stock was up almost 40% last year.
Oh, the stock was, almost $500 when I put the sell on back in 2008.
Man, just for those who don't remember, this was like your most hated name ever, and now it's your most loved.
Yes. 2 of the 10 chapters of my book, Exile on Wall Street, talk about how bad Citigroup is. Right now, this is by far the stock that I love the most because they're going from worst in class back toward normal.
What about, before I let you go, the super regionals? You have overweight on State Street. I mean, I think there are, questions again about those banks, at least in some respects, because of what interest rates have done. Can you be optimistic about regional banks in a still elevated interest rate environment?
The bond market is talking to Washington, D.C. They're saying, be careful, because if bond yields, 10-year yields go, say, past 5 or 5.5%, this thesis has a wrinkle in it. Not Citigroup, but the general thesis does. So as long as Washington, D.C. listens to the bond market and doesn't have deficits or inflation that's too high, then the regional banks should do quite well, too. And the banks like PNC and U.S. Bancorp and Fifth Third, Bank America, don't forget, and State Street, not quite a regional bank, but that would also be in my buying list. So I have a nice shopping list here for banks right now.
But you say if. I mean, this is if Washington listens. The bond market can scream loudly for a while, and Washington may not be paying attention for a while.
Well, Washington, D.C. may be forced to pay attention. If the bond yields go too far past 5%, there'll be enough disruption that something will have to give.
We'll leave it there. All right, Mike, I appreciate you. Thanks. That's Mike Mayo, Wells Fargo Securities.
The Fed can have an effect on long-term interest rates by their balance sheet, and that's how much money they put into the economy or take out of the economy. During the pandemic, they put about $5 trillion into the economy, mostly by buying bonds. And when they sell those bonds, that tends to increase interest rates. And they've sold about $2 trillion of those bonds since 2022. And that's why interest rates, part of the reason interest rates have gone up. So they can have an effect sort of indirectly on long-term interest rates. And what they've been doing, I think they've been kind of saving the banks. They're cutting how much banks pay out on interest rates like CDs, and then they're increasing the amount they take in through mortgages by increasing the long-term interest rates. So no wonder the banks are ecstatic and have been doing extremely well, as we will see with JP Morgan towards the end of this video. But first, on Monday, we have the Producer Price Index, and this are what the producers pay, the people who make the things we buy, what they pay for their raw materials and labor and so forth to provide us the goods. And the core PPI excludes food and energy, just the things you need to live, right? But it previously was 3.4% year on year, and now it's consensus is that it's forecasted to be 3.7%. That is quite a jump. Although month on month it somehow stays the same at 0.2%. But it's the year on year figure that's catching my eye in this case. And then if we look at the headline Producer Price Index, the PPI, which is kind of the main thing because it includes food and energy, month on month it's forecast to stay at 0.4%, which was a jump last month, and so it's maintaining the jump that it made last month. And so that's going up year on year from 3% to 3.4%. But all things considered, this Tuesday PPI will not be taken as seriously as Wednesday's Consumer Price Index, the CPI, which is the big deal. Because with the PPI, the producers can decide whether to carry the cost forward to the consumer. And they only do that if they have the pricing power to do it. You got to have PP, pricing power. With the Consumer Price Index, the CPI, on Wednesday, they are predicting that the month-on-month number will decrease to 0.2% on the core CPI number month-on-month. But I looked at the Cleveland Fed's numbers, and they're predicting that it's going to stay at 0.3%. And that'll be a problem because it shows that core CPI is very sticky, which it has been and has been a problem. And so it also could raise the core CPI year-on-year number, which is supposed to stay at 3.3%, but it could rise if that month-on-month number increases, of course. And then the headline number, month-on-month, the CPI is expected to remain at 0.3%, but year-on-year, the fact that it's staying that high month-on-month means that the year-on-year increases from 2.7% to 2.9%, which is 0.9% away from their 2% target. So it should be at least mildly negative news, and we will see what other news the stock market has, how the stock market digests this. After the ISM numbers, which were very negative, are they going to respond in force to these being mildly negative? That is the question. Just a friendly reminder that this is not financial advice because I do not know your personal situation. You need to do further research and gather further information to decide if the investments I present are right for you. I'm using JP Morgan, good old JPM, as an example because it's the bank I bank at, and it's a very dominant bank. And you can see that they have made over 44% in the last year. Their price to earnings is a good 14, and their earnings growth rate is a decent 10%. So it's actually kind of a buy, because while its price is $244, its value is considered to be about $285, so it's undervalued. So they are doing earnings in 2 days, I believe on Thursday, the 15th. So we will see what happens then. JP Morgan, good old JPM, will report earnings on January 15th before the market open. So that should be exciting. I'm tempted to buy some the day before. Thanks for listening.